Hi, this is Manish Patel with Valetax. I'm a professional educator for Valetax, and today we're going to be having a workshop on Fibonacci. Fibonacci is one of the most popular trading systems in the world. It's very powerful, but it's very subjective. So we're going to go through everything with Fibonacci today. One of the things I like to do is go for the PowerPoint, teach you about Fibonacci, give you rules and everything, and then go to live charts. So my goal is to go for the PowerPoint, show you about Fibonacci, show you the weak strengths and weaknesses, show you how to resolve the weaknesses, and then go and look at some real live charts. So two charts I'm going to focus on today when we go to live charts is gold, where you could have entered on a pullback where the profit taking was, rode it from 2,800 to where it's at today. And then I'll show you active trade, which is basically the CAD yen on the currency side. So we have that. If you look in the top right-hand corner, throughout the PowerPoints, you'll see this barcode here. This allows you to enter a Discord trading room. This is something we just set up for all our workshops going forward with me. So this is where you could ask any questions you want. You could post charts there. I'll post charts there. So I like it to be a live interactive trading room, Q&A and stuff like that. So you guys could sit there and be very interactive. A lot of times people take workshops. After they finish the workshops, you have a hard time remembering things, which is completely understandable. And that's why we have the support system there. We also will be posting announcements for other workshops we'll be having. And if there's something you'd like to see a workshop on a particular indicator or system out there, please let me know, because we do have a whole bunch of different workshops scheduled, from Fibonacci to Elliott Wave to Ichimoku to various different things. So please give us feedback on what you like to see, because we're here to pretty much help you guys become successful, consistent traders. Okay. If you don't know who I am, it's no problem. I'm not going to spend much time on myself because who I am really doesn't matter. What I could bring to you and how I could help you improve your trading is really what matters. But this kind of gives you a summary of who I am. I'm on LinkedIn too. I'm certified. I'm part of the chartered market technicians, which is the only certification globally around the world for both retail and professional traders. But the key thing is that um, I was a retail trader like you guys, then turned professional trader in 2007, 2008. I went to go manage money in Wall Street, managed money there into 2010. Also became a CTO for the firm there that helped create machines that did high frequency trading, which did 40,000 trades per second. 2010, I pretty much left, been trading my own money and been helping people around the world turn from retail to professional traders, because I love this industry. It allowed me to retire from telecom, and my goal is to help other people to get financially free. And that's one of the reasons why we're doing all these education series. They're completely free, and you guys have feedback, everything, so there's no cost at all. So let's begin. Introduction. What is Fibonacci? That is the magical question. Believe it or not, Fibonacci is around us everywhere we go. It's a ratio that's been in existence. Our bodies are Fibonacci levels. Every object that we see are Fibonacci levels and stuff like that. So Fibonacci is around us, around the world. It's a mathematical ratio that exists in every human and living being out there, and also non-beings too. Really, that doesn't matter at the end of the day. But if you look at all the Fibonacci levels, that if you take a math course, they'll go for all these different levels here. There's a lot of levels here, and it can get really, really confusing. So what we're going to do is we're going to focus on the key levels that are really important in trading as we move forward. Okay. So the very first thing we're going to do is we're going to take all that list of Fibonacci levels and narrow it down to certain levels. These are the main levels here. and I'll talk about when to use each level. Okay, so these are the main ones here: 38.2, 50%, 61, 100, and then you have all these others. So here are all the levels here. But when we get to the charts, get to trading, I'll show you exactly how to use each one and what each one means. And I'll also share my experience with you too on everything. Okay. So let's talk about what Fibonacci is. So when you have a trend that's going up, this also applies for a bearish trend when things are going down. So you have a bullish trend here, it's going up. At that point, we say this is 100% Fibonacci level or 1%. So the trend is the beginning of Fibonacci, okay? When the profits taking starts to occur, this is what we call a Fibonacci retracement. So that what the profit taking is called retracement, and that's basically a certain percentage of this huge trend here, okay? The profit taking here, you only want a small percentage of this big trend here, because if it's too much, that means it's going to retrace the whole thing and possibly reverse. It can never continue to keep on going up. So that's the very key thing to understand, is that these retracements have to be a small amount in order for it to keep on going up. And so this is the scenario here, okay? And we'll talk about what that percentage should be as we move forward. Once it gets to a certain profit-taking level, then it's going to stop, reverse, and it's going to start to go up. This is what we call the trend continuation or the Fibonacci extension, okay? So retracement is the profit-taking that occurs. So we're going to watch the retracement, the profit-taking, see where it stops. Once we see it stop, then we're going to look for it to then start to continue this trend, okay? So this is what the whole architecture, the chart pattern looks like. Does anyone have questions on this architecture? A lot of people use a lot of different terminologies on the web, but really what we're going to do is we're going to say the retracements are profit taking, and these extensions are basically where we're getting in, and these extensions turn out to be targets. Okay, so I'm going to start relabeling these words here so you understand exactly what each means as we move forward. Okay, so module 1 is pivots. Before we could draw the Fibonacci extensions and retracements, we need to understand what pivots are. Pivots mean a lot of different things to a lot of people, and it can be subjective. So let's go through the definition of what they are. Pivots are support resistances when price reverses, okay? So there's two types of pivots that exist out there. There's the pivot high. So this is where price is going to go up, 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 then all of a sudden stops and then comes down. So this is like a little triangle formation here. The high of the bar, you draw a line there, and that basically is the high of the pivot, which represents the resistance, a ceiling, okay? If you look at the other side where price is going down, it stops and then starts to go up. The lowest point here, which is a reverse triangle, is basically a pivot low, and that represents a support, okay? So pivots, we're going to define as being highs and lows of the bars. Is everyone okay with that? Yes? Okay. And so when you draw Fibonacci levels, you always want to go from one pivot to another, which we'll illustrate in just a moment. So where are pivots? So here's an example of price here. So price was going down, 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 down. Then it stopped here. Then it started going up a little, then came down, going up, 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 and then it stopped. This is a trend. So a trend is going to go up, come down a little, go up, come down a little, go up, come down a little, and eventually it will stop, and then it'll start to come down. A lot of times they call this the institutional wave, where this is going up, 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 up. A lot of times retail people don't capture that institutional leg. What they do is they wait for the institutions to buy, and then when they start profit taking, which is the retracement, that's when you as a retail trader is going to be looking to get in. So we're going to wait for a trend to develop, and we're going to say that's the trend, that's 100% of the trend. Then when profit taking starts to occur, that's when we're looking to enter the trade. So if this is the profit taking that's occurring, this should be a percentage of the whole movement up. If this whole movement starts from here to here, that's 100%. If it comes from here back to the bottom, this retraced 100%. That's not good at all, okay? What you want is all these people that got involved here, you want them to take a certain percentage off, but not all the positions. So really, you don't want to see this go below 50% of the whole movement up. So at some point, you got to basically say, this is too much profit taking, and it's not going to continue the trend. And that's what we're going to determine. In this example here, the retracement was 78.6%. That means it moved down and it retraced 78.6% of the entire move. In my mind, that's too much. And I'll explain that in a moment. So if you retrace more than 61.8%, then your probabilities for this to go up, to retest this high here and then break it are low. So for this to trend continue to go bullish is very low if you break a certain 61.8%, okay? So here, this is profit taking, then it stopped, then this trend continued, and then went up to here and then stopped, okay? So this never got back to the high here at all. This stopped here, and the reason why it stopped here is because this was too much profit taking here. And we'll define that in just a moment, okay? Distortions of pivots. We talked about how pivots you want to use from the highs and lows. Some people use the pivots, you'll find the pivot here, but instead of using the high of that bar right there, they use the closing price. So you could use pivots using the highs, or you could use the pivots of the closing prices or the opening prices. And that's where distortions happen, is everyone will know that this bar here establishes the pivot, and they'll know that this bar here establishes the pivot. But some people may use the high of that bar, some people may use the closing price of that bar, and that's where the subjectivity comes into play, and that's where the confusion comes into play for a lot of times, okay? And we'll help you eliminate that in just a moment, okay? If you have any questions, you're more than welcome to ask in the meeting chat room. Also, you could go off mute and ask those questions too, okay? Retracements. So let's go through and define what we mean by retracements and extensions even more, okay? Retracements are used to determine when profit taking is done and the trend is going to continue. This is when you're going to look to enter the trade, okay? So you're going to look for a trend to be established. Then you're going to look for profit taking to take place to a certain level. Once it gets to that certain level, you're going to look to buy or sell and then enter that trade with a determined conditional stop and then look for the trend to continue. So when you trade Fibonacci, you basically are trend traders. What you're doing is you're only going to enter the trend when profit taking occurs after a current trend, okay? And later on, we'll go to the charts, we'll pop up gold and CAD yen, and we'll show you exactly where the trend was, where the profit taking took place, how we entered, and go from there, okay? So there's three types. When we're dealing with retracements, you want to look at three levels: 38.2%, 50%, and 61.8%. If it gets past 61.8% retracement, in my mind, remember I said my mind, the trend is pretty much over. It means it's got a very, very low probability to retest the high or low and for it to continue, okay? The lower the percentage retracement, the higher the probability for it to trend bigger, okay? So if you only retrace 38.2%, then this has a high probability to trend for a very long time. If it comes down to 50%, it still has a high probability to trend, but it gets weaker. The further you have, the more higher a retracement you have, the more profit taking you have, the less the power of the trend to continue. Okay, so there's a direct relationship there. But this is the boundary condition where if you get past this level here, it's not, you have a low probability for that trend to continue. And at that point, I really would not look to trade it at all. Okay. So that's there. Okay. So now 38.2, I love these levels. Why? Because if you look at a big trend here, an institutional trend, which is 100%, if you look behind the scenes of this and you go to the lower time frames, what you'll realize is that trend does not go up in a straight fashion at all. What it typically does, if you look behind the scenes on the lower time frames, you'll see it go up, you'll see some profit taking to 38.2%, then you'll see it go up 38.2%, then you'll see it go up 38.2%, then up here and so forth. So what you'll see behind the scenes of a nice institutional trend here is that it will keep on retracing 38.2% retracement for that trend to occur. So a really healthy trend will always have some profit taking that always occurs. Okay, that's something to definitely look for as you move forward. Okay. So now, if you look at major pullbacks, so we're going to now look at the retracement levels and we're going to look at both of them. So this is a trend here. When profit taking occurs, we're going to look for it to occur, which is a major pullback. We're going to look for it to occur to 50% or 61.8%. So those are the two levels that we're going to look at completely. We're not going to look at the other small minor ones at all, but this is a major pullback here, and we're looking for it to retrace to 50 or 61.8, okay? So in those two levels here, we're going to look at both of those levels and how to react with them. So you're going to have some situations where it pulls back 61.8% retracement. When it gets to that level here, then you could look to buy at that level here. And then what you want to do is you want to use a buffer below that level for your initial conditional stop. A lot of people ask me what that buffer should be. You could use a percentage of an ATR 26 bars is what I use. And so you could use a certain percentage of that to be a buffer to cover volatility spikes and stuff like that below that level here, okay? And then if it stops at 50%, now at 50%, there's two different ways you could use conditional stops. The very first one is where you have the 50%, it stops here, you're going to place a buy entry here, but then what you'll do is your stop would be the buffer below the 61.8%. If you do it this way, you have a lot more risk with the initial stop, okay? Some people like to do it that way. Other people like to just have a buffer off the 50%, not even try to let it get to the 61.8. So in this scenario here, what you're doing is you don't have the stop below the 61.8% retracement. You just have a buffer off the 50%, and at that point, you're willing to buy. So those are the two types of order entries that you could have off the 50% retracement value. Okay. So now, let's go through the problems and solutions, okay? So as we talked about, there's two major pullback levels. Which one is the best to use? There's a 50% and a 61.8% retracement value, okay? So the question is, which one should you use? So this is a balance between risk versus missing trades. And this is something you have to determine. Reason why is it has to fit your personality, okay? There's no perfect scenario, no matter what anyone tells you with Fibonacci, between buying at the 50% retracement or the 61.8. It's a matter of risk versus missing trades. So if you buy at the 61.8, which is the boundary condition, which is between it being a major pullback and it reversing completely, here you have a higher probability trades, okay? But you have to be patient and you have to be willing to miss some opportunities. Because sometimes some trades are going to get to the 50% and you're not going to enter those trades at all. So these trades that get to 61.8 have a higher probability of success, but you may miss out on some opportunities that stop at 50% and so forth. Okay. The second one is where you're more of an aggressive trader, where you're going to buy at the 50% entry. If you're buying at the 50% entry, you understand that it could go below that level to the 61.8. So in this scenario, you're definitely going to enter, but you can have a higher risk. So the first one has a lower risk, higher probability of success, but asks you to be more patient. Whereas the second one basically will be entering, and you'll be entering more of a risk level. So now, if you're just trading Fibonacci a certain way, these are your probabilities here. I'm going to show you in a minute how you could trade either one of these and not worry about all the probabilities. Okay. Another thing you could do is you could use trailing stops. So once you enter the trade, you know where your conditional stop is. And then as it goes up in your direction, you could use the pivots minus a buffer as your stop. So I'm giving you many different ways you could use money management for your conditional stops. You could use trailing stops. You could use Fibonacci levels as for your conditional stops too. So one way is using pivots as it goes in your directions to use as a trailing stop. Another way is to use Fibonacci extensions, which I'll show you in just a moment, as trailing stops too. Okay, extensions. These are what we call profit targets. So we're assuming that you entered the trade at the Fibonacci level, the retracement level. Now that you enter the trade, the key is, where do you start to take some profits? Where can it go to and stop? Okay, and that's the magical question. Reason why is most traders, believe it or not, are profitable in their trade. But the biggest thing they have and the issues they have is they give back everything. And you really don't want to do that at all. So Fibonacci extensions are going to help you determine where that trend now that's continuing, where it could stop and reverse. Okay, so it could tell you where you should do some profit taking as you move forward. So let's go through and look at these extensions here. So on the extension side, you have 78.6, 88.6, 100%, 127, and was 161.8. I highlighted the blue. And the reason why is everyone on the web are going to know the 100%. Okay. However, a lot of people do not look at the 88.6 and the 127. These are very, very critical levels, and especially the 88.6. When people enter a trade, they always think it's going to retest that Fibonacci high or low. No, it does not always happen. A lot of times it'll fall short of that pivot high or low, and it typically will get to this 88.6, stop there and reverse. So a lot of times you enter a trade, you have where you're going to take profits at the 100% because you ignore this level here, and then it completely reverses on you where you see all your profits dwindle away. You don't want that to happen at all. If you're in a trade, it gets to 88.6% retracement, please tighten up your stop so that if it does get to this level here and reverses, now what happens is you're not going to give back all your profits. Okay, so you have that level here. The other level I like to always go for and talk about is the 127. Why? When people think that it broke the pivot high or low, it's going to keep on going for a very, very long time. No, there's a boundary condition for it to go very long, and that's at the 127. If you could sit there and break the 127% extension, then it has the possibility to keep on going higher and higher and higher. And you'll see that with gold. When gold, there was a Fibonacci retracement on the weekly time frame that was around 2,800. And then if you looked at entering there, then what happened is it got to the 127 extension, blew past it, and that's the reason why gold went higher and still high today. Okay, and we'll show you that with a live chart in just a moment. But these two key levels, a lot of people do not talk about them at all on the internet. If you've taken Fibonacci courses, you'll see that hardly anyone talks about those two levels at all. Okay, and that's something I want you guys to pay attention to because they're very critical. So extensions are basically the targets, okay? So here is the levels here. So now one thing I want to take the time to do is I want to show you how to draw these. So if you take your Fibonacci retracement tool, when you have a trend here, what you do is you'll click here first, then you'll click here second, and then you'll drag it down. When you drag it down, it'll tell you where the 50%, 61.8% retracements, everything are, okay? So that's using the retracement tool. The other thing, and then you have extension tool. I find all the tools are very confusing. So one thing I recommend you do is just learn how to use the retracement tool. And you could use the retracement tool for extensions just by where you click from where to where. So again, if you click from here to here, so this is your starting point here, and this is your ending point here, with your retracement tool and drag it down, it'll tell you where the profit taking will be, which would be here and where you would look to buy, okay? Now I'm gonna take that same tool, the retracement tool, and I'm gonna click it from the top here to the bottom here and drag it up. And that same retracement tool will give me all the Fibonacci extensions. So I'm not going to use the Fibonacci extension tool in the charting package. I'm just going to keep on using the retracement tool and just click on different points and it'll give me the same thing. Is everyone okay with that? Yes? Okay. And I'll show you that on the chart in just a moment, okay? But that gives you an idea. So I like to keep things simple, and that's the simplest thing is to do is learn how to use one of the tools, which is Fibonacci retracement, and then just click on different points in the pivots, and it'll give you the same thing. Okay, and when we go to live charts, I'll show you exactly where that's at. Problem here, there's 5 possible targets. How do you use this in trading? Well, here's how I recommend you use it. If you entered at the 50% retracement, then what you want to do is when it gets to the 88.6% target, which is the Fibonacci extension, you want to tighten up your stops. At least go to break even. That means when you get to this 88.6% retracement, change your conditional stop from wherever it's at to your entry, okay? Then when you get to 100%, I will take some profit there, and then I will take some profit at 127%. That's my recommendation for you, okay? If you entered at the 61.8 here, then what you do is when it gets to 78.6% retracement, okay, you want to tighten up, you want to go to break even. Then it gets to 100%, take some profit, and 127% take some profit, okay? So I connected the 88.6% to the Fibonacci over here, the 50% retracement, and this one to that one. So these two levels here, my goal is to get to break even. And then at these levels here is where I start to take some profit as we move forward. Any questions on that? This is my personal recommendation based on trading experience, okay? And if you do it this way, it's very hard for you to lose. If you do lose, get stopped out, it's for a minimum risk, believe it or not. Because a lot of times, even if you're wrong, you'll at least get to 78.6% or 88.6% retracement and then reverse. So if you get to break even, you're not going to lose at all. Okay. There, and then, or you could use trailing stops, or you could use other Fibonacci levels. So this is number 3, is pretty much other ways of you could do it. Okay. Clustering. So now that we talked about how to draw the Fibonacci levels on one time frame, we're going to talk about how to start removing the subjectivity. There's many ways a lot of people talk about how to remove the subjectivity. Okay. One way is what we call Fibonacci clustering. The second is basically using multiple time frame analysis, and there's other ways too. So I'm going to show you both methods with some examples, and then what we're going to do is we're going to go to some live charts, and we're going to show you how I use Fibonacci, and we'll apply it for gold, and then we'll apply it for a CAD yen currency trade. Okay, so here's clustering. So you have multiple pivots in a trend. It's hard to determine the exact price where price is going to go on a pullback. And this is because there could be multiple pivots there. So it's very hard to determine which pivots to use and so forth. So if you have multiple pivots, then what you're going to do is Fibonacci clustering, and you're going to find out where a lot of them come together, and wherever they come together, that's the key levels you're going to use. So let's go for example, because a lot of words, it's very, very confusing completely. So here's a trend here where this was going down, 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 down. In this scenario here on the left hand, I'm going to use the highs and lows of the pivots. So I'm going to draw from here to here, okay? So the very first thing I'm going to do is I'm going to draw from the pivot high here, and I'm going to draw from the pivot low here, and then I'm going to drag my retracement tool up, and it'll show me the 50% here and the 61.8% here, okay? The other way some people do is they use the closing and opening price. Over here, I'm going to use the opening price here, and I'm going to use the opening price here. When I drag it here, now I have the 50% here and the 61.8% here. And if you look at the two values, they're very different. You may not be able to see it on the charts, but the 50% on the over here is 113.23, and over here it's 114.71. Over here for the 61.8, it's 118.24, and over here it's 119.35. So you have like 100-point difference between the two on just where you're drawing the Fibonacci level from. Now, if you're a trader, that's a big, big difference, right? And you can't really afford that difference there, that subjectivity. Because if you think about it, trading should be about trading probabilities. That means you want to remove the subjectivity out of it. So how do we do that? So here is the two scenarios here. So over here, what I did was I marked off over here, if you look at here, these levels here, okay, the highs and lows. Then what we did was we used another pivot, okay? So here, instead of using this high from here to here, okay, I'm now going to use a different one, which is from here to here. So this is a different pivot here to here. So you could see these dashed lines here without numbers are basically where the Fibonacci levels were from here to here. And then I drew from here to here, and you could see that this 61.8% retracement right here matches the dashed line of the others. So this level here is a Fibonacci clustering where different pivots, believe it or not, have converged with that level there. So this is the main Fibonacci level here, not these others at all. And that's the one I'm going to use because that's where multiple pivot Fibonacci levels cluster together and they give me that level. So what I'm going to look for it to do is get to this level here, which it did right here. Let's clean this up a little. Right there. So this is the level I'm going to look at. I have an alert here. When the alert gets triggered, it's above it. So I'm going to wait for it to get below it, which is right here. Once it gets below it here, I'm going to enter this trade here short, right here, betting it going down. And then I could use this up here with a buffer as my stop right there. Is everyone okay with this trade with Fibonacci clustering? Yes? So it gets confusing and it gets very difficult because you have multiple pivots here and a lot of things. So a lot of people teach you how to do that. To me personally, this is confusing and it's very hard to do. Okay, so do I use this method? No, but I wanted to explain to you guys on what other people are doing and teaching so you understand the scenarios there. One of the reasons why I don't like this is it's very complex to do that. It's very subjectivity. But the thing is that if you keep on looking at charts too long, you're going to start overthinking this. And if you're having to find all these pivots, then have to look at the highs and lows of them, it gets very, very confusing. So I don't like that at all. Okay. The second method I'm going to show you in just a moment, as we talked about here, it can intersect. This is the problem solution and so forth. The second method is what a lot of people do, which is called multiple time frame Fibonacci. Okay, this is a great method. This is a lot easier than the Fibonacci clustering, and I would recommend you could start with this. Okay. And here, two major problems can exist in Fibonacci levels. Higher timeframes can override lower timeframes. This can result in lower probability of success and so forth. Instruments have high volatility and all that, okay? So here's all the words behind it, but I want to go to and step you through this example. So when you do multiple time frame analysis, whether it be Fibonacci or anything, my goal is to get a high reward risk ratio. From a money management perspective, if you listen to the last workshop we had, we talked about having a 3-to-1 reward risk ratio on all your trades to be consistently profitable. Well, the only way you're going to be able to do that, believe it or not, is to do multiple time frame analysis, where you want to take the reward from the higher time frame, but take the risk from the lower. And that's exactly what I want to take you down the journey with Fibonacci to do that. So what we're going to do is we're going to look at the Fibonacci level at the higher time frame, but we're going to enter on the lower time frame to enter this trade. Okay, and this will give you a good reward risk ratio, which is 3-to-1 or more, and that is our goal. So remember, if you were in a money management session before, we always talk about technical analysis. A lot of people put emphasis on it, but it shouldn't be. It should be money management. So you really want to build a technical system on money management. So if you take Fibonacci clustering and then you think about money management, it's going to be very, very hard for you to be consistently profitable. However, if you take multiple time frame Fibonacci, you're building a Fibonacci system on top of money management, which is your foundation, which is really, really what you want to do. And that's the journey we're about to take you through right now. Okay. So here's a trade here. This is on the monthly time frame. Okay. So I have a trend here. It goes from here to here. It's been a bullish trend. This is 100% of the Fibonacci level, which is trending here. Okay. Now, if you look at it here, this is now retracing. So if I draw my retracement values, it retraced to here, 50% and 61.8 are at these levels. Is everyone okay with this? Yes? So I'm going to draw my Fibonacci retracements on a monthly time frame or higher. Then I'm going to go down to my lower time frame. Okay. So if I go down to a 4-hour chart, believe it or not, a 4-hour chart has a high probability of success. The reason why is that it's a bridge between swing traders and long-term traders. So 4 hours, believe it or not, give you a high probability. So if I look on a 4 hour, it looks like bearish. And then you can see these lines are at the monthly levels retracements in the 50% and the 61.8. So you could see here on a 4 hour, it looks bearish. So it's going down, down, down. It got to the 50% monthly retracement level. Then it broke it, kind of went up a little, didn't go much at all. It says 1, 2 pivots, and then came down, broke it here, then came down here. Okay. Then you finally have a move up. Then you have a little pullback here. Then you got to this level here and you broke it and kept on going up. You guys okay with that? Yes? So even though the monthly here is bullish, right here, this is bullish, but on the 4 hour, it looks bearish. And that's exactly what you wanted to do. You want to get at these monthly levels here. Then you want to see buying action that takes place, then profit taking, and that's when you want to enter. So your goal is to enter off the 240 minute, take the risk off the 240, and get the reward off the monthly. Okay? So in this example here, you see it going down, 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 got to 61.8% retracement, then it goes up, okay? So there's a couple of ways you could look at this here, okay? You could look at it here when it made a move up, then came down here. You could look at the Fibonacci retracement off the 240 to enter here, or you could wait for it to get above to here, this 50% retracement right there, this monthly 50%, and then look for it to be a bullish move, then pull back to this level here, and then enter. Okay, so there's a couple of points you could look to enter depending on how aggressive you are as a trader. But what you're looking for it to do is bounce off either the 50 or the 61.8% retracement off the monthly levels, and then you want to see a bullish movement here, bullish trend, pullback. So here is one point where you could look at buying here, or what you could do is look to buy after it broke the 50% retracement. So after it broke the 50%, you're looking for a trend here. So right there, you could see here go up, up, up. And then what you do is you're looking for it to pull back to this level here and then go up. You guys good? So this is one method you could do. And I love this type of scenarios. And why? I like to see it get to the 61.8, which is the boundary condition. I really don't like the 50% that a lot of people do. I really don't. I like the 61.8. I like it to hold at that level, then come back, break above the 50, go up, and then come back and retest this 50% here for the monthly time frame, which is also a retracement level for the 240. If those two match, then I could see this going up. And now, believe it or not, I'm going to enter here. My risk is going to be a little low here, and I'm going to access this on the monthly time frame. And this is exactly the scenario that gold went through. And I'm going to show you that in just a moment. But this is how you could make the most money off one contract with very low risk. So in these type of scenarios, when you use the reward from the higher time frame and risk up the lower, believe it or not, you could sit there and get over 8-to-1 reward risk ratio very easily because your risk is very low. Any questions on this? No? Okay. So my trading plan. I'm going to put this up, but I think you guys are probably getting tired. You have everything here. You can watch the recording, but this is everything I've been showing you. You could pretty much go through here and you could see it. I'd rather go to the live chart in just a moment and you could see it in action, everything. Okay, so now let me stop and share my chart. Let's go to a live chart. Okay, can everyone see my chart? Yes, great. Okay. So this is TradingView. This is a simple charting package here. I got price action here. I wanted to rewind. I did a replay here to get back to gold here. This is gold on the weekly time frame. I look at the GC futures because I'm in the US. In your platform, you're probably looking at XAU USD. Pretty much the same thing, so don't worry about that here. But this is where basically I had a huge movement going up here, and then you saw two big red bearish bars. So when you start seeing two red bearish bars on the weekly, that means you're going for a pullback, okay? So I'm gonna take my retracement tool here, and I'm gonna draw it from the bottom here to about right here. And you could see 50% retracement right there. Can everyone see everything okay? Yes? Okay, so I drew a black line here where 50% retracement was, and I could draw another black line here at the 61.8. These are my boundary conditions here, okay? Now, I did not know if it's gonna stop here or go there. And in fact, if you looked at it initially when on the weekly time frame, it closed a little below that level here to a point it could have gone there, okay? Now, if it stops there, okay, then the question is, where is it going to go to? So I'm going to take my retracement level right here, and I'm going to draw it down to the bottom point here and extend this out. Oops. Let's do this so you can see easily. So I'm just going to take my same tool, going to keep on using retracement, use it from here, right there, and draw it out, okay? So if you look at this as a small trend here, it's going to come here. The boundary condition is 61.8, which is right there. So I'm going to draw a line there. Is everyone okay with that? Okay. So now I draw two lines, okay? So here's the 50% retracement here. There's a 61.8. If it stops here, which over here it went up, when it did that, if I draw the extensions, this is a 61.8. If this goes up above that, that means now it's got a high probability to retrace this and keep on going up. So what I'm doing is I'm using the boundary condition, which is do or die, for this here. Because if this was a bearish trend from here to here, it would stop here at 61.8 and then start to come down. So I'm going to use that as my condition here and use that. And I want to see it break that level, and then I could look to get in. Okay, so I'm using in Fibonacci the boundary condition of 61.8 as the level to tell me if it's going to trend continue or not. So I'm using a philosophy two different ways, okay? So over here, okay, so now it got to this level here. So I wait for it to break it right there. And the moment it pulls back to here, I enter this trade here, and now I'm off to the races. Is everyone okay with that? Yes? So you could do this off one time frame, but what you're doing is you're using Fibonacci to determine where it's going to stop. And then when it goes up, you could find that boundary condition where you could see where it's going to stop and come down or keep on going with the Fibonacci retracement the other way. And this is the do or die condition here. Or you could go down to a lower time frame here. This is weekly. This time frame is weekly, but you could use on any time frame you like. Okay. So here is, if you go to a lower time frame here, this is when it got to the weekly 50% retracement here, okay? Then it went up. And then if you look here, how much did it retrace? So if you look here, it bounced off that level, came up to here, and then it retraced here, which is right around 60% right there. This went below that level a little. Let's zoom in some. So right here, it hung around 61.8, 61.8, 61.8, okay? So you could have looked the buy here at the 61.8 if you went to the daily. It went up all the way up to here and then stopped. So if you look at how far it went, okay, so if you bought here, then you would see how far can it go up. So if I come here, click here to here, you could see it went to the 1% level here, right here. Then it did not hold that level here. Notice once it closes above it, you want it to stay above that level. It closed above it here and then came down. So at that point, you would have to exit the trade completely, okay? So you exit it there, then it decides to come back down here again, and it's just playing around here, okay? And this is all because this level here, it has not broken it and tested it. When you break these Fibonacci levels, you want them to break it, come back and test it, and then go. If it doesn't do that, then it's got a high probability to reverse. Like here, it broke it, should have came back and held it and then gone up, didn't do that at all. So this is a fake break. This is a fake break. Over here, you broke it, came back and held it. Now that's a true break right here, and this is what caused it to go up. You guys okay with that? Even here, you could see that basically it broke it here, then finally came above it, broke it here, never retested this level here until here. Once it retests it and holds it, then it could go up. Everyone good? Yes? No? So, couple of things from here I want to kind of go through. If you get to a Fibonacci level, you want it to hold it. Then you want it to break it and test it again. If it doesn't test it again, I would not enter. That's the number one thing I could tell you from my trading experience. And you could see here, if you were looking to buy off this level here, it broke it here. I would not be buying it here at all until you retest it. After retested it here, then you could buy it. But you want to break, retest, and buy. Okay. And you could see here, it broke it here. You could have bought here, but it didn't hold it. Over here, you could have bought here after retested it, but didn't hold it at all, okay? Over here, broke it and retested it here, that was a buying opportunity. So in this trade here, if you just wanted to buy off the weekly level, you would buy right here when it retested it here. If you wanted to buy when it basically went up and got to the boundary condition of 61.8 and broke it, then you'll buy here. So there was two buying points for gold in this trade here. One was here at this level here, and one was roughly around here. Everyone good? And if you do either one of them, and then you look at it where it's at today, you would be buying there, and you could see here, it took off huge. And you could see here, when you had two bearish bars here, there's hardly any retracement. This has not gone and retraced any major pullback at all. The last time you had a pullback here on gold was basically November of last year. Ever since then, it really hasn't done much. There's one level in here, which it did. So if you missed that one, there was another opportunity here. Right about here, and you could see here, it got to the 61.8 right there, held it right there, okay? So if you did that level right there, 61.8, and then you see where it has to at least get to a break above that level, there's a 61.8 right there. So this is the conditional right here, right there. This was a little more ugly compared to over here. And why? This got deeper into the trend. Everyone good? If you look at the monthly time frame, you could see that this is minor retracements. The biggest one was here. So here you could do this weekly, you could look at it daily, okay? So you could look now that gold's going for a retracement now, and if you look here on a daily, you could see here, gold right now, if you look at it, is at the boundary condition right now, which is right here at 61.8 right now here. So if you look at the 4-hour daily there and just go to a 4-hour, you can see here it broke. Let me delete these lines here. It broke below it here, then got closed above it here, retested it here. So you could enter here. So you could enter at this position here. Your low would be, your stop would be a couple points there. All right, let me get my drawing tool. So we're looking to enter here. Right there. And there is where we're looking for it to be. Agreed? Okay. And if you look at wherever it could go, right here, you could just draw from here to here. Looking for at least to get to 88.6, which is right there. You're looking at that level right there. This is your trade here. You guys see that? Yes? But this is a trade I don't like buying here. Here, I don't mind. And why? This is a volatility spike here. I want it to come down like this and then hold it here and buy. So this right here, really, if you take out this volatility spike, it doesn't look like a pivot at all. This looks like a pivot high. So I really want to do is, if once it closes above here, if the next bar it does not test this here, I want to wait for pivot high to occur. There's your pivot high. Now I want it to come back and test it there. This is where I buy right here. Right there. And this is where I buy here. And now that you're going up. So now if you look at this here and want to manage it off this. So my risk is off this trade here. A low here. You could use that low right there as your stop. And then you could see, okay, from here, it came from here, and the low here, and the 88.6 is right about right there. So this is where I'm going to start taking some profit, where I could change to break even and then go up. And if you look at it, we're pretty much almost there. But this is a 5-to-1 reward risk ratio to this level here. Do you guys see that? Now, we've gone so many different directions, right? So my key thing to you guys is that if you're doing a retracement off one time frame, at least make sure it holds that level. And then if it holds it on the next bar, buy at that level, it coming back to retest it. Okay. But I really suggest you go down to a lower time frame and see what happens when it gets these levels. Because here it broke it. Now you want to wait for it to come back above it. And then once it comes back above it, then buy when it retests there. So if you do this concept here, no matter if you're buying on your trading time frame Fibonacci level or lower, you're going to be safe. Is everyone good? Okay. The last trade right now, this is the active trade right now, is CAD yen. This is one of the biggest currency pairs moving right now. A lot of people are thinking dollar is, but no, it's this one. If you look at this here, this bottomed here and then came all the way up to here. Sorry. So if you look here, this came from here to here, okay? This, believe it or not, did hit it. It's just a spread that's a little different right here. So this hit the 50% retracement right here, believe it or not, right there, and it's going up. Do you guys see that? If you look at the daily time frame here, so this is the 50% right here. And if you look here, this hit the 61.8 right here. And this is exactly what I like to see if you're looking at the levels. You tested it here, you held it. Next bar, you came back, you tested it, held it, and gone up. So if this is closed below it, I want it to close above it, then test at the next bar. Since we tested it and didn't close below it, next bar I wanted to test it, hold it, and then go up. And that's exactly what I like to see here on this bar here. So on this bar here was the entry for this trade here. Sorry, wrong tool. So if I look at this entry here, I'm looking for it to enter right here, using that inner bar low as my stop, and I'm looking for it to retrace to 88.6, which is right there. That was 3-1, and now it's here. And you could see here, if we draw the extension tool, the key level for this thing here is after the 128 is this level here. If I could get past the 127% retracement here, this thing could keep on going up even higher. But all this started with a Fibonacci retracement from the higher. That's the key. I'm accessing the rewards from the higher time frame and finding the Fibonacci levels on the lower. That is the very, very key level there. So you take any currency pair, anything. I really would take the time over the weekend and find the levels, Fibonacci levels for any of the currency pairs and go from there. Timing is everything, okay? And if you do multiple time frame analysis with Fibonacci levels and you time it with the weekly, you're now trading with the higher time frames, accessing the rewards to a point, no matter what you do on the lower time frame, you have a higher probability of success. And if you get to the Fibonacci level on the higher time frame, and then you look for a trade on the lower, that's what we call timing-based Fibonacci trades. Everyone good? So it's not just doing Fibonacci with price, we're also going to do Fibonacci with time. And timing is where you're looking for multiple time frame Fibonacci levels. And that's what that gives you. Questions? I hope everyone joined the chat room. If so, we could sit there and start looking for trades together as we move forward. Here's the barcode here again, if you have not joined the chat room. Okay. So we pretty much have gone for Fibonacci. Now, how do you optimize this further? This is something that we're going to have in another session, is if you take Fibonacci and put in wave patterns, that's called Elliott wave. So Elliott wave is just advanced form of Fibonacci in a certain wave pattern. And we're going to have a workshop on the Elliott wave soon as we move forward. So this will take wave patterns and apply Fibonacci to them to optimize Fibonacci even more. Any questions? No? Hope you guys liked it. Any feedback? Jesse asked a question, higher time frame. So this is a personal opinion, okay? So I've been trading over 10 years, 16 years now. And you know what, we did a lot of research on time frames and what time frames will help you become successful. And so let me kind of go through that with you. If yeah, okay, while I do that, someone asked us to show this trading plan here, right there. One of the things you realize is that if you're day trading, 10 and 30 minute are the best time frames to day trade with. And when you day trade, since you're trading against the machines, you really want the 10 and 30 minute to be in sync. If they're in sync, then you could basically day trade and beat the machines, okay? The machines are not really going to climb higher than and get into the 1 hour time frame at all, because their goal is to do a huge number of trades per second, so they're trading on the lower time frames. The 60-minute is the bridge between day traders and swing traders. So a 1 hour time frame, believe it or not, has a higher probability of success. Okay. Then you have 2 hours and 4 hours, which are swing trading time frames. And the 4 hour is critical because it is the bridge between swing traders and the higher time frames. The higher time frames are daily, weekly, and monthly. So if you really want to trade with a daily, weekly, and monthly, if the 4 hour is going in the direction of the higher time frames, then now you're going to trade with the higher direction. You have a higher probability of success. So believe it or not, the 1 hour and the 4 hour are the two time frames that have a high probability of success, and people just don't realize it. Because a daily, weekly, monthly will not go unless a 4 hours is there. So 4 hours got to push it for the daily, weekly, monthly to go. If the daily, weekly, monthly are in the pullback, then you'll see the 4 hours starting to go down, or for a bullish scenario for profit taking. But it will not continue the trend unless the 4 hour comes back in sync. Now, we've gone through a lot of scenarios here. My suggestion is, one thing I'll do this weekend is I'll go through the currencies, look at Fibonacci levels for the weekly time frame, and post them in the chat room to kind of help you guys there. So if you're in the Telegram chat room, I could sit there and post charts there for you and kind of help you there and go from there. Any other questions? Nope. Did you guys like the workshop? Did you find it confusing? The link, someone asked for the link. Give me 1 sec. Here's the link if you need it directly. Did you find anything confusing? Things that maybe need clarification in the future? Best way to learn, believe it or not, is actual live trades, right? And I think once we go through and post a live chart on in the chat room and step through it, I think you'll understand that a lot better. But there's so many different ways you could use Fibonacci that I wanted to cover everything out there because it's a huge topic on the internet. Many people use it many different ways. So I wanted you to see all the different angles. But like I showed you, the biggest thing the way I use it is one, when you get to Fibonacci level, if you hold that level, next bar, you want to retest that level, hold it, and then go up or down, right? If you don't see that, it will happen later on, and that's when I'm looking to enter. If you break it, you want it to break back above it for a bullish scenario, then retest it to go in and then trade it. So if you look at the architecture of entry, that's huge on that side for Fibonacci. And like I always tell you, I look for Fibonacci levels on the higher time frame and then look for entries on the lower. So we've pretty much completed 2 workshops now. If you need the recording from the first one, please let us know in the Telegram chat room. The first one we covered was money management. I think that's the foundation for everything that we do. It's something that I had to learn in order for me to turn from retail trader to institutional. And if you're a retail trader today, you're really not going to become an institutional professional trader unless you understand money management. It's a clear fact, and I can tell you that now. I've been teaching for years and seen that over and over and over. That's the reason why I wanted to do the first workshop is money management. It's boring, but it's necessary. So if you need the recording, please let us know in the chat room, and we'll definitely put it out there for you. Thank you guys for taking the time to attend the workshop. I definitely hope you found it worthwhile your time and found a lot of useful information. As I mentioned, this weekend I'll start posting some opportunities out there, and then we could step through it together. Remember, the journey of a trader is lonely unless you're in a trading group, and that's the whole reason for having the Telegram chat group. Thank you, everyone.